Before we begin, I want to go over the legal disclaimer language. This presentation is not providing any investment advice, nor am I seeking for you to invest in any of the funds managed by Stabilis. This presentation is for information purposes only. Good afternoon. Thank you for attending this conference. Today, I'm going to talk to you about bridge loans. I've been in the loan investing business for 30 years, 12 years at Goldman, 6 years at Salman Capital, and I started Stabilis 11 years ago. During this time, I focused on bridge loans for 4 years, and I want to tell you today why I think it's the best all-weather loan investing strategy. So what is bridge lending? Bridge lending is typically senior secured lending with similar risk to traditional loan products like bank loans and CMBS loans, commercial mortgage-backed securitization loans, but they have higher returns. So how does this happen? This happens because the securitization market and the bank loan market tends to be very commoditized. They have created boxes in which loans have to fit. Otherwise, the borrower doesn't get the capital. I'll give you an example of 2 loans that we've made. First example is a well-located property right outside McCarran Airport in Las Vegas. On your way back, returning your rental car from Vegas, you would fill up your car at the gas station located at this property. It was in a CMBS trust and was close to maturity. What was the issue? They had a spill. The spill needed to be cleaned up. They'd gone through the process with the state of Nevada to clean up the spill. And there was a mandated process on how that was being done, but the loan got redlined. It didn't fit the box anymore. We did the work with our consultants, understood there was no risk here, made the loan, and 18 months later, it was taken out by a traditional lender. So that's why in this example, we got short-term returns. Another example is that borrower doesn't want the money because the borrower's box doesn't fit what the lender is offering. This example was a Kroger guaranteed retailer, grocery store, and a Tractor Supply guaranteed Tractor Supply store with 7-year leases. So term lending, investment grade credit in both cases. And the borrower had bought the asset at a good price. Now, CMBS was offering him 10-year locked out financing, which he didn't want. So why are we so lucky? We were able to provide him a short-term deal where he's able to close the transaction and then sell this property after he gets an extension done on the Kroger lease, which he was in the process of doing. But he doesn't want 10-year locked out money. He wants a short-term loan, which after 12 months, he can sell his asset. So a common question I'm often asked by investors is, why does this opportunity exist? And the answer is the US economy is a 25 trillion economy. And the lending market of commercial real estate and commercial and industrial loans is 6.3 trillion. It is one of the largest lending markets. And given the transaction flow in the US economy, there are always opportunities to put capital to work where the borrower's need don't fit neatly into a box that the commoditized lenders have created. That's why bridge lending opportunities exist perennially under most market conditions. I would venture to say under all market conditions. These bridge lending opportunities have improved significantly post-COVID. An example of that is that the commercial mortgage-backed securitization market has dropped in half from its 2019 peak during 2020, and the numbers in 2021 are expected to be similar. So that half of volume, which is over $50 to $60 billion, is going to be an opportunity-rich target market for bridge lending. So where else can I invest? Let's look at bonds. Let's look at the bellwether 10-year Treasury bond. The yield on the Treasury bond in August was 0.5%. It closed over 1.6% recently. That's an increase of over 1% in yield. And that translates into a drop in price of over 9%. What happens if the yield continues to grow the way it has and increases by another 1%? Well, you'll see another 9% drop in price. What's the likelihood of that happening? Well, you have a 1.9 trillion stimulus going into the economy, and the Fed in its recent minutes has said that it's going to be pretty dovish and it's comfortable with inflation at 2% or even a little bit higher. Well, that will translate into a 2% or somewhat higher bond yield. Suffice it to say that bond yields increasing by 1% to 2.6% is much more likely than them decreasing by 1% to, again, about 0.5%, which makes bond investing somewhat risky today because an increase in yield will translate into a continuing drop in price. Where else can one invest? Well, equities, stocks are a logical place. Let me talk to you about Dr. Robert Shiller's most recent metric, CAPE. You may remember Dr. Shiller, he's a Yale economist, he's a Nobel laureate. He came up with the Case-Shiller index, which indicated how high housing prices were prior to the 2007-2008 housing crisis. So what is CAPE? CAPE is the cyclically adjusted price earnings ratio. What it does is takes the current price of the S&P 500 and divides it by the 10-year average earnings of the S&P constituent companies. That index today is at a 20-year high. The last time it was higher than its current levels was in December of 1999, which predated or presaged the dot-com bubble and crash. The stock market dropped by over 47%, peak to trough. I'm not saying it'll happen, and I'm not saying that equities are so overvalued that tomorrow the stock market will drop. I'm just arguing that stocks seem to be fully valued at a minimum. All is not doom and gloom. You can make double-digit downside protected returns in today's market. Let me tell you how we do it. First, we cast a wide net. We have a sourcing system we've been using for 11 years. We have 48,000 contacts and we score them. What does scoring mean? Well, we send them outgoing blasts twice a week and also follow that up with phone calls. And we are scoring every interaction. If the counterparty is opening our email, if he's reading it carefully, if he's calling us, each of these interactions gets a score. The higher score is when they give us an opportunity that makes it through to our system for further review. So this allows our sourcers to focus on the counterparties that have the highest likelihood of giving us deal flow. So the secret is systematic follow-up. This has resulted, for example, in this quarter, us doing business with our repeat borrowers that needed to access a bridge loan market again. The second piece of the equation is to sift carefully. We reject 95% of the deals that we see through this wide sourcing net and invest in only 5%. Again, it's a matter of a systematic approach. We have very experienced underwriters. As I said, I've been in the loan business for 30 years. Some of my colleagues have been in the loan business for longer. And we attach, in addition to it, an analytical model that is based on experience that we've had. We can go over that later. Suffice it to say, we are rejecting 95% of the deals that we see to invest in only 5% that allow us to target double-digit returns on a downside protected basis. The third piece of the equation is monetization. Monetization is equally important. We monetize relentlessly. The team is very experienced. I've been doing this for over 30 years. Other members of the team have actually been doing it for longer. We went through portfolio selection and it is critical. We've invested over $1.3 billion since our inception, but monetization is equally important. We've resolved over $850 million in assets, including over $150 million in assets since COVID. And in 90% of the cases, given these are bridge loans, they're going to follow the green path. The loan is going to get to maturity and they're going to pay off, maybe with a little bit of cajoling. But if not, we know what we are doing to get your money back. Let me put some meat on the bones and give you examples of situations where we've lent money. The first example is Black Hole Studios. This is a loan we made in December of 2020. It's a $45 million loan that we made at an 11% coupon and 3% in fees. It's senior secured by industrial properties that have been repurposed for sound stages. Properties are fully leased and cash flowing at $9.5 million with a conservative value of over $100 million, making this a 40% loan to value loan. The issue was he had a maturing lender that was Korean that wanted to reduce exposure to the United States and was threatening to pursue remedies. And he was in the middle of a discussion process to sell his business for over $100 million. So the last thing he wanted was to get into a dispute with his lender. He needed to solve this, and he needed to solve this yesterday. We ended up doing all the due diligence, getting up to speed with his business, going through the financials, and making the loan from Thanksgiving to before the end of the year. His loan matured over Thanksgiving. We gave him the money by December 31st. So this is an example of very quality assets and a specific problem that we are solving. This loan is going to be taken out by the acquiring company that's acquiring the business for $100 million at most LIBOR plus 500. Where the brokers aren't even returning our calls when we say, hey, are you interested in similar rates as we made this loan? Because it's 40% loan to value. The second example is O'Charlie's. It's a restaurant business in the southeastern Midwest. It's a franchisor. We made the loan in November. Like other restaurant businesses, they were struggling because of COVID. We made them a 9% loan with 1% in fees at 50% loan to value. It was a $9 million loan collateralized by at least $18 million of value on owned restaurants. While the borrower had $12 million of properties under contracts that were in the various stages of closing, they wanted to get liquidity against that portfolio of deals under contract. Well, we said, look, given COVID, we're not comfortable giving you $9 million against $12 million, which would be a normal 67% commercial real estate loan. We want all your properties. So they have 129 units, of which they own 27, and we took collateral all those 27 units. So our loan to value, even on a draconian basis during COVID, was 50%. They actually ended up selling the 12 million that they had under contract and significantly paying down our loan. And they sold those properties at 118% of our value, which would make our LTV even lower and around 40%. So you have to sift through and find value when there are opportunities with other lenders. I mean, this wouldn't fit a regular lender's box because it was during COVID and it was a restaurant business, although there was plenty of collateral, which is what we found, and we've been able to make a good loan. Let's recap. The bridge loan strategy is an all-weather strategy which works in most markets, but particularly well in today's markets. It's senior secured with comparable risk, but higher returns than traditional lending products. It is sourcing driven, but you're sourcing from a large market. It requires careful deal selection and, last but not the least, relentless monetization. Thank you for your time today. Please feel free to call us if you have any questions or if we can help you in any way.